what product should I get? Should I get an IUL? Should I get whole life? You go onto some channels and it's like all whole life. You go onto other channels, it's all IUL. And the purpose of this video is to have someone that can maybe represent both sides in a very respectful way. Tom, don't want to put words in your mouth, but you're almost all whole life and you run a mastermind called Whole Life Mastermind. And David, you've sold both, but you've maybe not.
I've only sold one whole life.
Okay, fair. Okay. So it's fair to put you in the category of almost all IUL, and you speak publicly in your book about IUL. So with that, I don't know how we want to go about this, but anyone want to take maybe a first stab at why you guys agree on almost everything, but maybe don't agree when it comes to the actual whole life versus IUL product, and how we facilitate that into.
I can take a stab at this. I think that whole life can accomplish a lot of the same things that I'm hoping to accomplish with IUL. After all, Ernst & Young, the product that Ernst & Young used, if you look at the Ernst & Young study, it literally says right there in the footnote, whole life was used as a volatility buffer type strategy, right? So in the down years, they borrowed from the whole life, and then when the stock market came back up, then they paid that loan back, right? So what I'm doing is I'm looking at the IUL as slightly to the right of whole life on the risk continuum. And I think that you only do IUL if you think that risk premium can get you a slightly higher rate of return over time. And this is where I think that slightly higher rate of return could be useful. If the goal is to accumulate 3 to 5 years worth of living expenses in your cash value of your IUL by day one of retirement, and let's face it, that's your deadline. You gotta have it all there by day one of retirement, because you never know if the first year of your retirement is going to be down or what have you. So the question is, whatever money that could have otherwise been directed to the stock market is going into my cash value life insurance. And the goal is to get 3 to 5 years worth of living expenses in that cash value life insurance. Which one will enable me to do it less expensively? Okay. Now, remember, I'm recognizing that IUL has risks, but I think that in exchange for those risks, I am getting, like I said, that slightly higher rate of return. So if the goal is 3 to 5 years worth of living expenses, and I put that money into an IUL policy versus a whole life policy, the bet that I'm making is that it will take less money to accumulate the 3 to 5 years worth of living expenses, which means that I'm not having to take as much money out of my stock market portfolio or redirect as much money to my IUL away from my stock market portfolio along the way. Because if I have to the more money I have to put into these insurance contracts, the greater the opportunity cost I'm going to have to experience along the way. So the question is, which one allows me, in theory, to invest the least amount of money to accomplish that end objective? Okay, so that's the first point that I would make, is that if you think that the IUL can reliably give you that 1 to 1.5 points more over time, then in theory, you would invest less along the way to be able to accumulate the right amount by day one of retirement. The second consideration that I would put forth is that I don't believe whole life policies, and Tom, you're the PhD on this, so feel free to sort of put me in my place. I don't think whole life policies are designed to build money up and then take money out permanently. Okay? Why? Because there's typically a net cost to borrow, okay? And if you don't pay that loan back, then there's a cost associated with those outstanding loans that can really take a toll as it compounds over time. One of the reasons why I like the IUL is because I can find a carrier that gives me a guaranteed 0% loan, okay? So when it comes time to take that loan out of the IUL to pay for my living expenses in retirement, I don't necessarily have to pay it back, okay? If I had to pay it back, how would I pay it back? I would pay it back with money that was otherwise in my stock portfolio earning whatever you want to say, 8, 9, 10%, 12% if you're Dave Ramsey. So if I have to pay that loan back, I'm taking money that could have otherwise accumulated in my stock market and pay that loan back. there will be an opportunity cost associated with paying that loan back. That money is no longer growing in my stock market portfolio because I had to pay my loan back. And so those are the two considerations that I work through. And Tom, I'm sure you've thought this through and I have a very good answer for it. But those are the two considerations. I'm getting a slightly higher rate of return. Therefore, I have to put less money into the contract to accumulate the requisite amount I need by day one of retirement. And because I can take that tax-free, cost-free loan out and I don't have any net interest that I'm paying, I'm not constrained to pay that back with money that could otherwise be growing in the stock market. And that the net effect of all of those is to build my wealth higher over time.
Yeah, and
if you believe that you can continue to get a reasonable rate of return in the stock market.
Yeah, and I will just say those two things are a big deal, though. It's really, one addresses the accumulation, and the other addresses a more efficient distribution, essentially. And so, but would you say those two are the main, and then everything else, that whole life also checks the box, the permanent death benefit, the long-term care-esque return, like all those things are relevant because it's an insurance contract. But the reason you like IUL are potentially a more efficient accumulation and a more efficient distribution.
Yeah, people come to me and say, Dave, the guy that wrote the foreword for your book, The Guru Gap, Wade Pfau, prefers whole life. I say, great. Whole life could totally work in this situation. I'm just saying that if the goal is to build 3 to 5 years worth of living expenses, it's going to take more money to pull that off. And money's not going to grow quite as quickly if you believe that the IUL, given that risk premium, is going to sort of push you further ahead.
Yep.
And then if you look at the Ernst & Young study, the Ernst & Young study says that the loans were paid back, and they're paid back out of the stock market portfolio. So those are my considerations. And I'm not in any way demonizing the whole life approach, because for crying out loud, Ernst & Young, that's the product that they use. And so you can't really vilify it.
Tom, what I would love for you to do is, on the whole life side, why are the reasons? And then if you could address what David talked about, and then David will have an ability to address your reasons, if that makes sense.
Yeah. There was a lot there. I'm not sure I remember everything that was said, but I'll do my best.
The main two is accumulation on the front end. I'll let you talk about the reasons first, and then I can rehash the two reasons why David prefers IUL over whole life.
Yeah, there's a lot to it. The three words I heard is "if you believe." This not where insurance fits in my opinion. Like I don't want my insurance to be based on a belief. I want it to be based on the fact that it's going to be there no matter what. So when I look at insurance as part of the portfolio, yes, it's got all the tax advantages. I use it heavily for my own accumulation, so I'm not disagreeing with that at all. But at the end of the day, that death benefit needs to be there. So having that guarantee in place is important. My fear of universal life in general as a category is, back to the 80s, you saw universal life contracts failing because they were illustrated at 12 and got less as interest rates went down. And then VULs were illustrated at 12% and then they got less because of market crashes. That's just one thing that can hurt a UL contract. The other one is funding. Does the client actually put the money in as planned? Assuming they have it and they have a good advisor, that will happen as well. And the third one is the carrier can change the rules. So, the carrier, typically speaking in the industry, the carriers have not gone back and charged clients more money for the internal charges. Like, that's not a good business practice. As soon as that gets on the front page of Wall Street Journal, guess what happens to your new sales? So that's not a good thing for the industry. It's a scare tactic, I think agents will say, but it's not really, based in reality. But with IUL specifically, when they're illustrated, they're based on floors and caps. Usually a floor of 0% returns is assumed. They'll usually guarantee a 0% floor. And then they'll illustrate based on a cap, which is the maximum you can get in a year. So if the market does 30% and your cap is 10, you only get 10. And the idea is that over time, you'll be somewhere in between that 0 and 10, probably 6 to 7% or whatever the historical data has shown. The problem, though, is if you get that bad period of time, and you get that 2 zeros in a row, or like 2000 to 2002, you get 3 of them in a row, and you were illustrated to get a compounding 6 or 7%. You're supposed to be at a compounded total of 20 something percent after those 3 years. You've got 0. Now you're mathematically capped and can't catch up. So that's what I'm thinking of when I'm thinking about a retirement strategy that can't fail. Is I don't want to be in a scenario where there is, a great recession or a great depression, and then my policy underperformed, and because of the rules in the contract, I can't catch up unless we have this outstanding bull market, which we've only seen a few times in history. So it's again, it's more philosophical than math. It's not predicting which one's going to do better. It's just, if I'm buying it for insurance, if I'm buying it for guarantees and safety, I want that guarantee and safety. And that's really where a lot of the leaning comes from. From the from the distribution standpoint, historically, insurance companies are largely investing in long-term corporate bonds to back up these whole life portfolios. So when you look at dividend interest rates, and actually was just in a seminar 2 days ago where they were talking about this, and I have some data of my own, where if you look at dividend interest rates over the last 100 years and compare it to the Moody's seasoned corporate bond average, which actually is a published index that a lot of the whole life carriers will base their adjustable loan rates on. It's like a single digit basis point, like 1/100th of a % difference over a 100-year period of time. So there are markets where if interest rates move up quickly, that can work against you on loan rates. Frankly, for the last 4 decades, it's worked in your favor, which probably won't happen again for at least the next little while going forward, where you've actually been paying less loan interest than the crediting rate on whole life. So over long periods of time, they kind of rise and fall together. But because it's because of the predictable nature of whole life, you can see it coming. It doesn't happen. It doesn't happen over time. And unless I misunderstand, in those guaranteed 0%, IULs, where it's effectively a wash loan, where they're going to credit your contract the same rate that you're paying in loan interest, you're still paying ongoing mortality charges and expenses inside the contract. So in a negative scenario, my understanding is that could actually work against you and be a little bit cannibalistic over time. Like income forever is a hard thing to create in those IULs on a guaranteed basis, or understanding that could happen, and it chips away at your death benefit. So I'm not sure if I addressed all of those questions, but I think the other one that I wrote down was the accumulation, that you can get money. You can put less money into an IUL to get the same result of that 3 to 5 years of assets. But again, that's based on an assumption. That's based on a belief that the indexes will provide better for you than you would get in whole life. Because on the back end, both insurance companies, IUL or whole life, they have the same team of actuaries, underwriters, legal team, marketing departments, commissions. They all have the same costs, and they all kind of show up the same way over long periods of time, even though it might look different on an illustration. But I have found that you can pretty much just as effectively get the money into a whole life with similar dollars.
And just to summarize, and David, I want to hear your response. If you're talking about life insurance as a backstop, not even a foundation, but as a backstop, you don't love the idea of messing it. Like, you would rather have it maybe be perform smaller and have a guarantee versus a belief around it could perform better, but it also could perform worse. And you also said, Tom, that like it could be a scare tactic, but there is a world where if a company was just not managed well at all, that they could just totally hike up, charge it. Like, that's what everyone says, like they have the ability to do, but in history, I don't think anyone's ever done that. And so I appreciate you acknowledging that. And then what you also said when it comes to distribution is, no, you don't have the wash loan, but the internal rate of return of the policy versus the loan rate is pretty close. And then, yeah, the difference is also is factoring in cost of insurance. And then you asked David, in the wash loan component, is there still a cost of insurance component to that? Is there anything else, Tom, that you wanted to say in addition to addressing David's thoughts around like why even more so, like why whole life, or is it really just like the guarantee? It goes back to the classic, like, guarantees. If that matters to you, it matters. Is there anything else you want to say before I hand it over back to David?
Yeah, well, that was the epiphany. That was the epiphany at the end of all my research and studies and historical data, and kind of digging into the details. Is there's, and you didn't say these words, but I almost heard it as you were talking. Is the word guarantee we're almost wired to believe, oh, if it's safe and guaranteed, therefore my returns will be more muted. What I'm telling you is that there's really two big things you get out of a life insurance contract. There's a better tax wrapper, okay? And all permanent life insurance has the exact same tax wrapper. And then there is the risk component. So risk and taxes, those are two of the big variables when you construct an investment portfolio. So if you can get similar returns, but none of the risk, that's a better risk-adjusted return. They call it the Sharpe ratio on Wall Street. Is how, for whatever our return was, how volatile was that asset? So with life insurance over a long period of time, whole life insurance, a dip, and I'm being very careful here. Big mutual dividend-paying, participating whole life insurance. It's not some of these other small carrier guaranteed, basically final expense policies. I'm talking about certain kinds. You will and have, and you should, unless their business model changes, get bond-like returns, but none of the volatility. They have indemnified you that away. In fact, they haven't guaranteed you zero. They've guaranteed a positive growth on that cash value over time. So this is such a complex topic, but if you are going to have a mix of stocks and bonds, replace a piece of that bond component, that safe component, or however you define that, with whole life cash value, and you will have a more efficient piece of that portion of the portfolio. That's what I'm saying. So it's not versus equities. It's not. There should be no opportunity cost. There should be no taking away from your upside exposure to equities, because we're taking away from the piece of every prudent portfolio, which should be some cash, bonds, and things like that that are traditionally more predictable. As long as that mentality is what people are looking at, is replacing that piece of the portfolio versus taking from equities or taking from other opportunity that is just a completely different nature, then I think that's where it's a win, and that's where it makes sense.
David, what's your response and comments on that?
Yeah, I think we're coming from two just different worldviews. I think I heard you say on a video once, Tom, that the reason you believe the way that you do is because you were weaned in a whole life company, in a whole life environment where they really inculcated this idea that you have to protect, you have to build a foundation of protection. That's sort of what you do right out of the chute. You've got to build a foundation of protection. That doesn't ever really enter into the picture for me. To me, I've got very stated objectives. Okay, the stated objective is you build up net worth as effectively as you can. You save as well as you can over time. You invest mostly in stocks during your accumulation period. I do think there would be opportunity costs if you started early off in life with whole life, and you're incorporating that bond-like alternative into the mix too early on in life. I do think there would be an erosion in your net worth over time, because you're taking money that could have otherwise harnessed the power of the stock market, and you're putting it very early on into a bond-like return. So I think that's a consideration. But really, at the end of the day, I am not using the IUL as a way to protect my assets. It doesn't even enter into the picture. I am looking at it as a tool. It's slightly to the right of whole life on the risk continuum. And when I say I believe you can, if you believe you can get, I'm being slightly deferential here, because we're both nice people and we're having a nice conversation. But I'm basing that on the idea that over the last 20 years, an IUL through a good carrier has gotten those types of rates of return. And I believe, and I've talked to actuaries who have done Monte Carlo scenarios on these things using caps of about 10% over time. And they say that 99.5% of the time, these policies stay in force when funded properly, right? When maximum funded and executed in the way they were intended to be executed, okay? So is there risk associated with down returns? Certainly, but you're getting something in exchange for that risk. You're getting a slightly higher rate of return. And I think that history bears that out. And over the last 20 years, we've had high interest rates, we've had low interest rates, we've had surging interest rates, we've had, so I think we've seen all sorts of different types of environments. And I think that an IUL through a good carrier that has integrity when it comes to cap rates has performed in the way it was intended to perform, which is to say a point to point and a half higher than what you could have otherwise gotten had you put that money into whole life. And I think that given the choice between having a guaranteed 0% loan and a loan provision where it could fluctuate based on whatever interest rates happen to be, or whatever the portfolio rate happens to be, where you could be paying 2 or 3% net percentage. If you look at the charts that show the net toll that takes on your cash value, because remember, that interest has to be accounted for somehow. You either have to pay it back, and how are you going to pay it back? Out of your stock market portfolio. You can use paid up additions or what have you to pay it back. I'm not using the right jargon here, I know, but the point is, there's no free lunch. That interest has to be paid somehow. And given a scenario where I can choose between having a scenario where the interest rate could ebb and flow over time, and having a guaranteed 0% interest rate that's guaranteed in the contract, I would take the guaranteed 0% every single time. So in summary, again, I'm looking at something where I think, based on historical rates of return, that I can get 1 to 1.5% higher, and to get that guaranteed 0% loan, so that I'm not required to pay that money back out of my stock market portfolio down the road.
I think your dogs are agreeing with you, David. I just wanted to double click on one thing you said. You don't use life insurance as like a asset. I don't want to put words in your mouth. You asset protection, or maybe like you maybe don't necessarily buy into like the backstop conversation. You said something like that, because I think that was the epiphany for me around like why you believe this. But then I can also understand if someone did see it as like a backstop, that was like a big part of their thesis, where they would say, yeah, I would rather have the guarantees because it's that important. You said it, and then I just wanted you to maybe repeat or flesh what you meant by that.
So the backstop in my mind would not be a whole life policy. It would be a guaranteed lifetime income annuity coupled with Social Security, possibly a company pension. So the backstop is I want to guarantee 100% of my living expenses and adjust those for inflation over time. And then I can use the insurance policy, the IUL, to accomplish some specific objectives in retirement, primarily the long-term care, but in some cases the volatility buffer.
Understood. And so you're essentially saying, which makes sense, if you're like, if this is not the foundation or the backstop, or then why would I, if that's less important to me, if I already have that backstop with maybe different annuities and Social Security and planning, then why wouldn't I try to get a higher outcome? Because that's where I'm going. But you could also see where it's like, if someone had that as the backstop or the foundation, and that was it, where it may bring a lot more peace of mind when it comes to planning, to say, hey, I would be willing to take less upside potential over time, but to have that quote unquote peace of mind. And I know that there will be other people in time you can mention that. I know the goal is, the reason why people do IUL is for that upside potential and maybe more efficient distribution. But I know that there's people that just say like, well, over a long period of time, that's going to be the exact opposite. I don't know if we even need to get into that now. But I think no one would do IUL if there wasn't that. You wouldn't take less guarantees and then get less, like you wouldn't take less guarantees for a smaller outcome in growth wise and a smaller outcome in distribution. I think that's a pretty fair statement. If we live in a market that wants to stay competitive, the IUL carriers have to try to give some type of reason why you would maybe part ways with more guarantees for that upside.
Let me just real quick, and Tom, you can weigh in on this. I've done comparisons where you take an IUL, you maximum fund it, and you just put the money in the fixed account. And then you run that out and compare it against a whole life policy where you're maximum funding it, and then you take loans out of both policies out the back end. So you're not even messing around with the index caps. You're not messing around with the fact that you could get 2 or 3 down years in a row. You're just going with the fixed account. And I know fixed accounts, you don't get the same thing every year, but it's based on interest rates. But interest rates affect whole life policies like they affect IULs as well. But because of that 0% loan, that IUL policy is going to distribute money more efficiently over time. than the whole life policy is, because you have to reckon for that net cost of borrowing that exists. That's a reality that you have to confront in the whole life policy. And so if you're just looking at pure building money up, even if you forget the index part of it, you just go the fixed account. You say, I don't want to mess with the index. There's too much risk associated with that. I'm just going to put money into the fixed account and do that each and every year. Couple that with the guaranteed 0% loan that I can distribute down the road. I think that's a pretty efficient way to go. It's not going to build the money quite as quickly, I don't believe. But I think that when given the choice of that approach versus the whole life approach, I think I'd still take the IUL.
There's really two ends of the spectrum when it comes to life insurance and retirement. One is the backstop approach, as I've discussed before. The other one is the fund it up to the MEC threshold, just as efficiently as possible, get cash in there for the purpose of taking it out. I would love to look at the illustrations and actually see that comparison. There's so many different options out there, and there's all nuances to every carrier out there. So I can't say I can comment about the entire industry. But like broad strokes, if you do illustrate it that way, where you're just going to spend all the money down, it's essentially giving a nod to the fact that you no longer want life insurance. You no longer have people in your life that you care about leaving money to. Or you no longer care about long-term care benefits, which eventually evaporate if you do take, systematic distributions out of a life insurance policy long-term. So my book, Permission to Spend, it's really meant as life insurance for life insurance's purpose, and here's why you want a permanent death benefit, because of the death benefit and the long-term care component. And by the way, the cash value is incidental, and it doesn't actually cost you anything over time if you're going to be owning bonds over a long period of time too. It's just a matter of strategically getting your assets into it effectively so that you can start to earn those bond-like returns. So, fighting over loan spreads, I can't do that effectively. It's based on too many assumptions, and I don't think that's true. I'd have to look at the illustrations. There's been a lot of scenarios and a lot of environments where whole life insurance is done far better than a wash loan. Depending on the carrier that you purchased and the loan provisions of that carrier. Again, they're also different. But again, it's really just what are you using it for? If you're using it as basically a tax dodge, as a way to have an unlimited, Roth-like vehicle where you can put money in and have some relative safety around it in a whole life or an IUL structure, then that completely ignores the conversation of making sure that those benefits are there to be payable 30 to 50 years down the road. So we may be saying two different things. Actually, is my philosophy. Yep.
Oh, it's good. Finish your thought. I'm sorry. I have a follow-up question for you.
Yeah, but my philosophy of whole life and retirement is to be that volatility buffer. It's to be that piece that you use a little bit, but not spend down. So maximum 90% loans that you just let sit there forever isn't even really part of the conversation I typically have. And frankly, in all my years in the business, having talked to every gray-haired person I could find, I still have yet to find one person that has a client who has ever done it that way in real life. In fact, they'll all tell you that it's typically yanking 50 grand out to take the grandkids on vacation or do some big thing or fix the house or make some other investment. Or actually, I've heard a lot of stories from 2022 where people took cash values to then go make investments and catch the wave on the upside.
Yeah, there's a lot of gray hair in the industry to talk to. So that's
and real quick, Tom, to be clear, I don't recommend that either. I get very, very uneasy with these illustrations where you build money up and they take money out for 35 years. That's why the two applications that I really advocate for are just the long-term care, where you're not really taking any money out at all, or the volatility buffer type approach where you're taking out 3 to 5 years. And chances are, and that concept really only works in the first 10 years of retirement. So there's a pretty good chance you may only take out 2 years, right? Because you're only taking out in the year following a down year in the market. So that could be 2 to 3 years. If you have 5 years saved, you could pay the money back, but you're not constrained to, because you don't have those compounding loan interests. So I agree with you there, Tom, that this whole idea that you would build money up and then take money out, like these illustrations are showing, year over year over year, and it's accounting for a 6% linear rate of return or 7% linear rate of return is just not realistic. So I feel more comfortable using it in these sort of constrained settings where you've got a very specific goal, a very specific objective, and it's more of a controlled setting.
And I think just I want to point out that both of you agree around not leveraging life insurance systematically in retirement. And while I also agree with both of you, Tom, like most people that I talk to is like, yeah, the illustration shows that, but you don't necessarily do that. It's not like an annuity where life insurance is built that way. I do feel like in my time of learning, I feel like that's been a little misleading sometimes because that's usually a big pitch on both sides of like a supplemental tax-free income. And again, I said so many things that are not compliant, just to be clear. I'm just saying what has been said. I just want to like summarize. It seems like you guys very much appreciate the life insurance benefits. And Tom, you're more of like backstop guarantee. You'll pay a premium for that. And David, you're like, well, if I could pay less to get check the same box and have a different to invest, I will by default have more. And it sounds similar to the concept of a little bit of buy term and invest the difference when you think about it that way. But I'm being like, okay, if I can spend less and get the same outcome over here, I have a greater return over here. But you guys both agree that life insurance in general is not that thing that you want to put all your money in. It would be interesting if I could find somebody who would be willing to stand by and say all your money should be in insurance. And that could be a whole different conversation. Because that is like, I just want to like point out we're all in the life insurance camp, but there's different parts of the camp. And even though we're talking about IUL and whole life, you guys are both maybe unpopular even in your own camp right now by saying what you said in this conversation. And I just want to point that out because I think we've all heard some wild things and yeah, I'll stop talking now.
At the end of the day, we both dislike Dave Ramsey, and I think that's what's important. When you really get down to the bottom.
Hey, don't rope me into this. Look, I mean, Caleb. At the end of the day, like you said, the word insurance. Like, I have no problem if a client wants to have 80% of their portfolio in cash value life insurance. God bless them. But there's more to the conversation than just a policy. It's diversification. So if I'm going to have 80% of my assets in life insurance, I'm going to want to own 8 different carriers. I'm going to want some of it to be VUL, so I have exposure to the upside when the market grows by 40%. I'm going to want some of it in whole life, so it's guaranteed and getting bond-like returns over time with guarantees in place. So hypothetically, if you were that person who believed you could put all your money into life insurance because it's this tax panacea, you still need to diversify. You don't want all your money with one company where some future CEO decides they don't want to support this product anymore. They don't want to honor the caps. You would diversify, right? So I think it's more about diversification than the asset itself that you're putting the money into, at least from my perspective. I think that's a personal decision of what percentage of your net worth should be there at the end of the day.
Tom, as we land the plane, is there any final thoughts or questions or anything else that you would want to ask David or just comment on?
I mean, I'm familiar with your work. I respect the heck out of it. I think more Americans need to be educated about these strategies and understand, the good that you can do with these strategies. I think a lot of people shy away from working with advisors because they're afraid of being sold something that's no good. So to have positive voices out there doing it, I mean, I'm thrilled to be on here with you. I love the work that you've done. And if there's any debate today, it's really philosophical. For me, I want guarantees in place because those guarantees allow me to continue to invest money into my business, my multiple real estate holdings, have more equities closer to and right after retirement, all the things that have historically generated the most wealth. Because if all I have is volatile assets and all hell breaks loose right before my goal, the whole plan fails. So that's philosophically where I come from. But I think done right, IUL can work. For me, I challenge the fact that over time it's going to do better than whole life, based on the way the crediting strategies are priced at the insurance company level.
David, we'll give you the final word here.
Yeah, I think the big epiphany I had throughout the course of this conversation is where Tom finds that sort of backstop or safety net, as it were, in whole life. to me, that's where I see the guaranteed lifetime income fitting in, into my retirement worldview, that you're using that as a rock solid guarantee that no matter what happens in the stock market, no matter what happens on the geopolitical scene, no matter what happens, who's elected president, right? You're going to be able to meet your living expenses no matter what. And that is what gives you the permission slip to take more risk in the stock market and sort of ride the vicissitudes of the market over time. And I'm a big believer that if you want to increase the likelihood that your money is going to last as long as you do, you have to take more risk in retirement. Dave Ramsey, the one thing he says is, don't put your money in bonds in retirement. That would work great if you actually had a backstop like a whole life policy or a guaranteed lifetime income annuity, both of which he demonizes and vilifies and rejects out of hand. And so I think that these tools allow you to do some really interesting things. They give you some permission slips to do some interesting things. I love having this dialogue, Tom, because I reject the notion that it's binary, it's either or. I think Tom has brought some really good points to bear in tonight's discussion. And I love the idea of using whole life as a bond alternative. As Tom Hegna says, reach into your portfolio, remove the bonds, replace them with cash value life insurance. You'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, experience a better outcome over time. That's a true principle. And so I really am in favor of these types of discussions where it's not, whole life is exalted and IUL is demonized. I think there's space for both of us in this market, and we're just using these tools for different ultimate objectives. And I appreciate having this dialogue.
Yeah. David, Tom, thank you, and have a great rest of your day.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this and asset make sense? Does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the and asset, different setups and designs that we use. And then we have an and asset vault that gives case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.